Welcome to the show. Let's talk to Mr. Bill Blaine. He's a strategist at Mint Partners. Very good morning, Bill.
Good morning, Moose.
How the devil are you, sir?
Tickety-boo, fine and dandy.
Right, I really wanted to do this interview. The reason we spoke 10 days ago and you said, I would love to come in on the 12th of this month because that's the day I'm going to predict the stock markets are going to correct, crash, have a pullback.
Okay.
Tell me more.
Well, it started off as a joke, and it wasn't 10 days ago, it was about 5 or 6 months ago. Somebody actually put me in the spot and said, Bill, you're constantly pessimistic about the end of QE and the effect that's going to have in financial asset values. When do you think markets are going to correct? And so I just stuck my finger up in the air and picked October the 12th. Why October the 12th? Because tomorrow is a Friday the 13th. So if we have a crash on a Thursday before the Friday the 13th, that's going to really ruin everyone's anticipation of the weekend. So I thought it was as good a date as any. And then I started looking at the data and the charts. And sure enough, if you take all the charts and start to draw out the long-term averages, they're all pointing at something happening sometime in October. Then, of course, you and I both remember 30 years ago this weekend, the Great Hurricane followed by the Black Monday crash. So October is always the most volatile month in the market. So if folk were to ask me if we're going to see a market correction, I'll put my finger sometime in October. Now, why would the stock market stage a correction? We're all very aware that for the last 3 months we've had a series of record-breaking highs in markets, a succession of topping days where the market is closed slightly higher every day. We were up again this morning, but it was only a fraction higher, but yet it is another top. Why is the stock market hitting such highs? Well, there's a number of factors. The first is there's anticipation of global growth, which is a great thing. We are seeing stronger numbers across the globe. We've got better output gaps in nearly every single developed country. We've got growth expectations rising and corporates reporting strong profits. That's all very, very positive. But at the same time, we also have a tremendous amount of money chasing financial assets. And this is all the money that's been pumped into the market as a result of QE policies, which has caused interest rates to go to record lows, has enabled corporates to borrow enormous amounts of money, most of which has not been used to build new factories or new infrastructure, but has gone into stock buybacks. And just changing for 1 second, I thought it was fascinating. Earlier this week, we had Walmart, the largest US retailer, announcing a 20 billion stock buyback program. I think that's incredible. This is a company that's facing an enormous challenge from the internet, and rather than coming up with something interesting and a clean strategy to reinvent themselves, what are they doing? Borrowing money on the markets so they can buy back their own stock. I think that's one of the big issues that makes me slightly nervous about where stock markets are going. All this money coming. Then, of course, the third factor to look at is we know that markets are always going in a random walk, as we say. Sentiment changes all the time, and we've so many different sentiment drivers at the moment. The politics, and one of the main ones to look at, forget all the noise in Europe like Catalonia, but be thinking about Donald Trump trying to get tax reform in the US. I think that the market is vastly overestimating the chances of that actually happening. If you actually drill down into the detail, the number of Republican senators and congressmen who are beholden to the current tax system is going to make it very, very difficult for Trump to actually get that through. And I don't think it helps that he's now picking fights with Republican senators who disagree with him. So for all these reasons, we have tremendous excess cash, and maybe the expectations are slightly overinflated. And then as a third area of factors, we've got the way in which markets are now working. We've got an enormous amount of passive money in the market, chasing funds that are trackers or ETFs. When the market turns down, we're going to see these funds accelerate their selling, because they are going to track what's going on. And there's a potential multiplier effect there as well. I don't think we really understand exactly how some of the algo-driven trading strategies and tracking strategies could potentially impact markets. I have a suspicion we will wake up in a year or so's time wise after the event, in the same way that you and I discussed after the 2007 crash, saying, oh, yeah, we should have known that CDOs were dangerous. We could have worked out that subprime lending was possibly slightly dangerous. I think we're going to see similar things happen with the way that trading changes in times of stress. At the moment, everyone's talking about how low volatility is because the VIX fear index is trading at all-time lows. That's actually pretty meaningless. We've got a situation where the whole market has convinced itself of the first positive factors, that the recovery is going to happen, and isn't really paying attention to the others. And you may remember one of my great mantras: what is the only objective the market has? To inflict the maximum amount of pain on the maximum amount of participants. So even if the crash doesn't come today, Moose, and I'll admit it is possible, I may be wrong, it's going to come at some point. It's not going to be a crash, it's going to be a correction. I still think after that correction, it's well worth getting back into the stock markets. And remember, stock market investment is not about market timing for a day, a month, or even a year. If we were to look at the stock markets and all other financial assets since 2007 and the financial crash, guess which the top performing financial asset has been?
Tell me.
It's been the US stock market.
Yep.
If you were in for the long term, you've made spectacular returns, almost 100% return over the last 10 years.
Okay, so we're talking pullback, we're talking some sort of correction. Obviously, you're saying October the 12th, and there's lots of reasons it could be the October the 12th, but the reality
It's as
is...
good a date as any.
As any. So October, historically, not a great month for equity markets. So how do basically the core finance people, if they think, I agree with everything Bill's just said, okay, how would you actually... how would you manage your portfolio through that? Would you be buying out of the money put options, okay? Would you be short futures? Would you be selling calls on your portfolio stocks? Would you be buying bonds? Would you be buying dollar yen as a risk scenario? What's the easiest?
You put forward a whole menu of choices there. I think the key thing is to think about your long-term objectives. What are you investing for? Are you trying to make short-term gains, in which case some option strategies to potentially protect yourself at a low cost against some downside risk? Or is it waiting for the right moment to put in some longer-term investments into that? And I think we need to look at three strategies there about the various asset classes to go for. Do you buy bonds? We know that interest rate hikes are coming. The Fed pretty much confirmed that yesterday. I do suspect we're not going to see interest rates rise substantially, but the bond market is so over. It's yesterday's news.
Okay.
We're looking very much towards global growth, which is going to drive stock market performance. However, much of that stock market performance may already be there in the market. So what else can you do? And we're thinking more about real assets. One of the most interesting things I came across recently is a study looking at 150 years of financial asset history. If you take stock markets, they typically return 6 to 8% in an average year, but you have a 22% risk that you're likely to lose money in any particular year. If you were to take UK housing, you're going to get something like a 7 to 8% return every year. And the
what's your risk
chances of
factor?
losing money is less than 10%. So your actual return from real assets, not financial assets, which these imaginary things that trade in markets, but real assets, bricks and mortar, they make real lower risk returns. Now, of course, it's difficult to invest in property. You can't go off and buy a share of a building. You have to own the building outright, and then you have to rent it or lease it, whatever. But there are other real assets that are worth looking at. And I think the long-term future of the market is going to be more focused on investors distributing their financial investments amongst bonds, which of course play an important role in any portfolio and will continue to do so. Careful choosing of where you play in the equity market, and also looking to put money into alternative assets, which is a host of other strategies in its own right.
We've run out of time. Give me one line to finish off with.
One line to finish up with. At some point in the next couple of months, it's going to be really quite noisy and chaotic, but after that, it'll be calm sailing again.
So says the man on his big. How is your boat, incidentally? We'll leave that one. We haven't got time for that. Bill Blaine, as always, strategist, Mint Partners. Thank you very much indeed for your time.